Hey guys, you're back with Steph and Dennis, and today I'm doing a fun video all about my investment portfolio again. So we're going to specifically be talking about risk level and the difference between having your money in equities versus not, invested in US equities versus global markets, and of course, like the title says, I'm also going to be talking about how I'm changing up my personal investment risk level within my Wealthsimple Invest portfolio again. So let's just jump into it. I'm excited for this one, so let's go. So let's start with a quick recap of what my investment portfolio looks like. I do most of my investing through Wealthsimple Invest, which is a Robo advisor. And if you don't know much about what a Robo advisor is, it's basically an algorithm that does the investing for you. So I can see my account and everything that's going on in there at any time. And I can also talk to real human customer support as well. But in terms of who is doing my investing for me, it's all done automatically online through this algorithm. So when I got started, I signed up, I filled out a bunch of questions online, similar to if you were to go into a bank in person, but instead of doing it in person, all of the questions are online for you. You then pick a risk level, and you also pick which investment account you want to start putting your money into and investing through. So in my case, I'm working on maxing out my TFSA or tax-free investment account first before moving on to anything else. Then I simply add money into the account and it's all invested for me. And specifically the Wealthsimple portfolios, they invest across the entire stock market using ETFs. I'm taking a quick coffee break, and I have to mention that lately I've bought some vanilla syrups to add into my at-home coffee, and it has upped the game. I can't say I still haven't gone to Starbucks and gotten a vanilla latte, but this basically tastes the same to me, and I've been loving it. Highly recommend adding the syrups. Now, when you're investing in these broad market funds, so you're not investing in single stocks or companies, but instead in funds that either track the market or parts of the market, there can be a few different types or many different types. So for example, on this channel before, you've heard us talk about the S&P 500, which is a very popular one. There's funds like VOO and VFV that specifically track the S&P 500 or those 500 largest companies in the US. Now, on the other hand, there's also funds that'll track the total stock market. So ones like VTI or VUN, those two funds specifically track the entire stock market, but again, just the US stock market. If you're building out an entire investment portfolio, you actually could just look at US stocks if you wanted to. They have one of the largest impacts on the global economy, but there are other markets to consider too. And that's what Wealthsimple's portfolios do. So they also do have some money into these other markets. Specifically, they have international markets, which their definition is Europe, Australasia, and then the Far East. They also have emerging markets, which is Russia, China, India, and Brazil. They have some money in Canadian markets, of course, also US markets, and then also global markets, which covers the rest of the world. So what this means is that with the Wealthsimple portfolios, no matter what your actual risk level is, you already have some reduced risk by having your money spread out across these different equities. So if we think about it, if all of your money was in US stocks specifically, and then the US stock market crashed, that means that your whole portfolio would be crashing too, versus there's already a little bit less risk inherently by having your money in different global markets, because if one country crashes, it doesn't mean all of them are. Okay, so this is the Wealthsimple Invest site and specifically their How It Works page. And the reason we're here is because we're looking at this risk level sliding tool that they have. So this is where you can really see what your portfolio allocation is going to look like based on what type of risk level and what type of portfolio you end up having. So obviously where it's at right now at the bottom of the risk level barrel, the conservative portfolio, you're going to be largely invested in government bonds and in fixed income. So gold, government bonds, corporate debt over here. And then as you go up into these higher risk levels, so from 1 all the way to 10, you're going to move into having less in fixed income and bonds, more in stocks and equities. This would now be a balanced portfolio, all the way up to a growth portfolio. Now, we did see a few comments on the last video that we did looking at my Wealthsimple portfolio of people saying that when they originally signed up, they only had a risk level of 3 or 4, maybe 5, and didn't see the highest returns. Now, obviously, the market's been on a stock high, bonds have been lower and having lower returns. If not, my portfolio was at a loss in the bond category, but it was my international equities, US equities that were up. So that would be the case if you had a lower risk level. It's not necessarily the platform that you have to leave altogether. You can change and play around with that risk level if you wanted to see higher returns. Now let's talk about that a little more. I want to pop into my portfolio to show you again. I've consistently been going up for the most part since having my portfolio here. But you guys know, like I said before, I had an 8 out of 10 risk level at first, which was still pretty high on the scale, but I still had a lot invested in the fixed income and bond side of things. And as I got more comfortable and as my confidence in my investing knowledge went up, and as I realized that the younger you are, the more time you have to recoup any losses you see in your portfolio, the riskier you can be, I ended up moving up to a 10 out of 10 portfolio. Now, what you usually hear is that risk level is personal. You guys have even heard me talk about it before when I said the first time I started to invest, when I went into a bank and met with a financial advisor, they asked me all these questions and I didn't really know how risky I should be. So obviously I was more on the conservative side. In general, ideally, younger people, and the younger you are, you're going to have a more risky portfolio because simply the fact that you have time to be in the market. So if you have a long time to be investing, you can in theory be more risky because you're going to have time to recoup any losses. You're going to buy when it's high, you're going to buy when it's low, and ideally you're going to have that high return. Historically, that's what's happened by the time that you actually retire and get older. And then over time, you make your portfolio less risky as you get older. Now, the key to that message is that you can't just be investing in a riskier portfolio when you're young and not learning more about investing at the same time. So even though in theory it'd be easy to have a robo advisor doing your investments for you at a 10 out of 10 risk level on the riskier side of things, mostly invested in equities, but then if you don't actually grow your knowledge and your confidence in investing, when we do hit some sort of market crash and all of a sudden the equities market's down for a period of time before it goes back up eventually again, which historically it always does, you might panic and end up selling off or wanting to do that. So the key is really being able to be more risky when you're young, not just knowing that you can do that, but also feeling more confident in that decision so you don't second guess it and don't actually understand why you're being more risky. Now, since making the switch to having the 10 out of 10 risk level portfolio, which still leaves you with having 10% government bonds and fixed income, we did actually find out that you can have an 11 out of 10 risk level, which basically means that you have 100% of your money invested in equities and 0%, none, invested in fixed income or bonds at all. Now, you actually have to contact Wealthsimple for this. We've shown you in the past how you can typically change your risk level from 1 to 10 on your own on the platform. They give you some warnings and information, but in this case, you can't do that. You actually have to contact through their customer support. And basically, they'll walk you through why you might want to switch your portfolio to an 11, why you might not want to. Overall, they were pretty easy to talk to. We reached out through the customer support chat box. They got back to us pretty quickly with all the information, and one of the things that they shared was this article here. So this is the article that I was sent by the Wealthsimple team called Why Hold Bonds at All. Basically, it's walking through how from their research, becomes a point when it's no longer beneficial or has a large impact on your portfolio to have more than a certain amount of stocks. So I believe that they specifically say once you get to 70 to 80% stocks, once you reach that point, the curve of the impact on your portfolio, it doesn't benefit after that point to continue adding more equities. So this is basically why, like I said before, if you go onto their site and try and change your risk level, you can't change it past the point of 90% equities. And that's because their research and what they have set up in their system, they believe that it doesn't benefit you necessarily to have a 100% equities portfolio. So instead, they kind of want that 10% bonds to be able to play around with. What that means is have the ability to, when the markets are potentially lower, the equities market specifically, and bonds are up, have that room of that money and that cash flow to play around and rebalance your portfolio. So it makes it easier on that side of things. And definitely good information here to read through, and it really describes exactly the research they've put into that and why that's what they recommend for their robo-advisor portfolios. This definitely was really good information to look through, and for most of you watching too, definitely good information to consider because it really is true that you're not going to see a major impact by switching your portfolio to being 100% equities. And this is where I want to be really clear that we're in no way telling you what to do with your investment portfolio. We want you to consider all the information for your own. We've given you these resources, including linking that article down below for you, but we of course still want to share what I'm doing with my investment portfolio. So for me, after sitting on this information for a bit and also talking through it with Dennis as well, like I said at the beginning of the video, because I feel like Wealthsimple's portfolios are already well diversified across these different global markets and therefore already have some of that reduced risk, and given my age, the amount of time I'm going to be investing money for the long term, and my risk tolerance, I do feel comfortable making the switch of having 100% of my portfolio in equities. So I am going forward and already have, we'll talk about it in just a second, going to be switching my portfolio to this 11 out of 10. The actual process for making the change was, like we mentioned before, reaching out to Wealthsimple's customer support through the chat box. They emailed me back and gave all that information, like the article we walked you through, and then I responded back by saying, yes, I'm still comfortable making the change to a 100% equities portfolio, and they were actually super quick. They emailed back the same day saying they'd start to make the change, and I'd see it within, I think, 3 to 5 business days. We'll pop up the message on the screen here for you all. So they really did action it really quickly, which was nice and easy. Now, I'm filming this about a week after that happened, and I have have seen that they've changed the allocations in my portfolio a bit, but it doesn't seem like they're done yet. There's still about 13% of my money in cash right now, so not invested into the equities yet, but they have gotten rid of all of my government bonds and fixed income. So maybe we'll put up on the screen what my holdings look like the day that Dennis is editing this video together, but we'll also just have to keep an eye out in the future of how things change, and we'll report back once it seems to have been settled and rebalanced. I'm popping in one more time because I wanted to show you what it looks like now that they have finished selling out all of my bonds and fixed incomes. So you can now see my portfolio is 100% equity and 0% fixed income in gold. What's interesting is that in the past, I could actually go ahead and change my risk level anywhere from 1 to 10 at any time if I wanted to. But now if I wanted to click change, because they've made this special request basically to bring it up to 100% equities, I would actually have to request the change from a portfolio manager if I wanted to bring it back down. It's now like a customized theme. So just something for you to notice there, but otherwise I can still go in and view my holdings. Also, I obviously can't speak to the actual impact on the performance of my portfolio yet since we just made this change, but we'll definitely keep an eye on that throughout the year, the next couple months, and make sure we share the changes with you guys on how that impacts my performance. We also have to keep in mind that we're potentially heading into a time in the market where stocks might not be performing as well, which is funny timing with me going to an all stock portfolio. So we'll have to keep that in mind and let you know how that goes too. It's also a good real-time test of my risk tolerance and holding everything steady, but keep in mind that we'll have more of that content coming up in the future too. Really quickly before we end this off too, if any of you are curious about how you could change your portfolio risk level, so not necessarily to an 11, but just in general, and if you want to see how that would impact your holdings, we'll pop up on the screen right now how you can do that within your Wealthsimple portfolio yourself. All right, everyone, that's a wrap for this video. We hope you liked hearing all about risk levels and actually me walking you through the change of having my investment portfolio be 100% equities now, and also specifically how that works for Wealthsimple. So we'd love to hear all your thoughts on a risk level for your investment portfolios down in the comments below. Also, if you haven't seen our previous videos all about the potential upcoming market crash and our thoughts all about it, make sure you check them out next door, and we'll be back later this week with more videos. Let's go.